I want to start with something that might genuinely surprise you. This tax season, millions of retirees are opening their mail and seeing higher tax bills. Not because they went back to work. Not because they made an error. But because of a law that was actually designed to help them. And here's the part many people didn't see coming. Some long overdue Social Security payments are being taxed all at once. Those surprise tax notices are landing right now. And if you receive Social Security, or plan to in the future, this could affect you more than you realize. So stick with me. Understanding what's happening could save you stress, and possibly money. Before we dive in, let me ask you something. Have you ever opened a tax bill you weren't expecting? Even a small one. That moment of, wait, what is this? Let me know in the comments. Now let's break down what's really going on. For decades, two rules frustrated many public workers: the windfall elimination provision and the government pension offset. These policies reduced Social Security benefits for teachers, firefighters, police officers, and other government employees who had pensions from jobs that didn't pay into Social Security. Lawmakers said those rules prevented double dipping. If someone had a pension from non-Social Security work and also qualified for Social Security through other jobs, their benefit would be reduced. But many workers felt that wasn't fair. They had paid into the system through other employment, so why should they lose benefits? In January 2025, the President signed the Social Security Fairness Act into law. That legislation repealed both of those provisions. For more than 2.8 million retirees, this meant higher monthly benefits. And for many, it also meant retroactive payments going back to January 2024. That's where the twist comes in. The Social Security Administration recalculated benefits and began issuing lump sum payments in 2025. Some retirees received checks averaging around $6,700. In certain cases, monthly benefits increased by several $100s, even over $1,000. For many families, this felt like long overdue justice. But then came the tax surprise. Under current IRS rules, Social Security benefits are taxed in the year they are received, not the year they were originally owed. That means if you received a large retroactive payment in 2025, the entire amount is reported on your 2025 tax return. And that can have consequences. It can push you into a higher tax bracket. It can increase the percentage of your Social Security that's taxable, up to 85% depending on your combined income. And it can even affect your future Medicare premiums, because Medicare uses your income from 2 years prior to determine what you pay. That means a 2025 income spike could impact premiums in 2027. It's understandable if you're thinking, how can money owed to me for last year suddenly raise my taxes this year? It feels frustrating. You finally receive what you were supposed to get, and then part of it goes right back out the door. Now let's pause for an important perspective. Even if taxes increased, most retirees are still financially ahead overall. Their monthly benefit has permanently increased. And there may be relief options available. In 2025, as part of a broader tax package signed by President Donald Trump, a temporary senior bonus deduction was introduced. Eligible seniors may deduct up to $6,000, or $12,000 for married couples, if their income falls within certain limits. This deduction is scheduled to run through 2028. While taxes on Social Security weren't eliminated entirely, something that had been discussed, this deduction was presented as targeted relief for middle-income retirees. But there's a bigger issue behind all of this. Social Security itself is facing long-term financial strain. The trust funds that help pay benefits are projected to be depleted around 2032. If Congress takes no action, benefits could be automatically reduced by roughly 20% at that point. So lawmakers are walking a tightrope. They want to improve fairness for retirees, but they're also cautious about policies that reduce tax revenue further. Some members of Congress have introduced a proposal called the No Tax on Restored Benefits Act. The goal is to exclude those retroactive lump sum payments from taxation in the year received. Supporters argue this is simply correcting a timing issue. Money covering multiple years shouldn't be taxed as if it was earned in one. However, that bill is not currently law. So retirees must plan based on existing rules. So what should you do if this applies to you? First, carefully review your SSA 1099 form. This document shows your total benefits received for the year, including both monthly payments and any lump sums. Second, ask a tax professional about the lump sum election. This special calculation allows you to allocate retroactive benefits to prior years for tax purposes, without filing amended returns. It doesn't always reduce taxes, but sometimes it can make a meaningful difference. Third, think beyond just income tax. Higher reported income can affect Medicare premiums through IRMAA. It can also impact eligibility for certain credits or deductions. You want to look at the full picture. A retired teacher recently shared her story with me. She was thrilled when her monthly benefit increased. She felt acknowledged, finally. But then her accountant explained how much her taxable income had jumped. She told me, "I thought this was good news. Why'd I feel anxious?" That reaction is completely human. Financial changes aren't just numbers. They affect our sense of stability and security. Stepping back, this situation highlights something important. Social Security isn't just about a monthly check. It's deeply connected to tax law, Medicare rules, trust fund solvency, and broader policy debates. There are proposals to eliminate taxes on Social Security entirely. Others suggest raising the payroll tax cap to strengthen the system. Some advocate a balanced approach with both revenue increases and gradual reforms. But here's the reality right now. Up to 85% of your Social Security benefits may be taxable depending on your combined income. And retroactive payments are counted in the year they are received. So practically speaking, if you already received a lump sum payment in 2025, be proactive. Review your return. Ask about the lump sum election. Understand whether your Medicare premiums could change in the future. If you're not yet receiving benefits but expect changes due to the repeal of those old provisions, stay informed. And consider setting aside part of any large retroactive payment until you fully understand the tax impact. It's also worth remembering, taxation of Social Security benefits isn't new. It dates back to the 1980s, when lawmakers needed additional revenue to stabilize the program. What's different here is the timing and size of payments hitting all at once. If this tax surprise affected you, you're not alone. Millions of retirees are navigating the same forms, calculations, and confusing moments. The goal isn't just to react to surprises, it's to anticipate them. When you understand how Social Security, taxes, and Medicare interact, you're better prepared for whatever policy changes come next. I'm glad you're here, learning, asking questions, and thinking ahead. That alone puts you ahead of the curve. And I'll continue bringing you clear, steady updates so you can make decisions with confidence, not confusion.